Hello and welcome to the Investment Markets Podcast, where we aim to discuss investment matters that impact self-directed investors. I'm your host, Darren Connolly, CEO at Investment Markets, and today I'm joined by Jarrad, Stuart and Nick Chant from Sharpbridge Funds Management. We're going to be discussing investing in global equities. But before we get into it, I need to remind you this is general advice and general information only, and nothing in this podcast should be construed as an investment recommendation. As always, you will need to decide what is right for you. Welcome, Jarrad, and welcome, Nick. Now, my first question is really just to get a little bit of an understanding for you guys have launched a new global equities fund. It's in the market for about a year. You've had fantastic, stellar performance. But before we get into sort of the main body of the podcast, I want to know, how did this idea come to fruition? Where did you have the idea? What was the trigger behind it?
Thanks, Darren. Well, we kicked off the fund on the 1st of April 2025, but Nick and I, goes back to uni days. We've known each other for a long time, and we both went different ways through our career paths, but always been thinking of how we could do a fund that has a reasonable scale to it and allows us to showcase our stock picking ability across global markets, and so brought that to market, and the rest is history. Had some really good performance since then.
And it wasn't Australian equities that got you excited?
Well, our specialty is global, just to get the market reach and depth of the scale that allows our strategy to work really well. So we do have a little bit of Australian equities in the fund, and we do look at Australia. The bulk of it is international, though.
And what is it about the funds? Because setting up a fund is a difficult thing to do. It's very entrepreneurial. Great admiration for people who go down this path. So you're about a year in and you've had good performance, or stellar performance so far. What is it that has driven that performance? Because it's been a bit of a turbulent time in global markets.
It certainly has been. Our benchmark has performed around 18%, so we've caught that tailwind. But also our own stock selection has led to a total return of net of fees 96%, which has been a fantastic run. And we're an unleveraged, just a standard global equities fund in most aspects, but we do hold 20 stocks in the portfolio. So it is quite concentrated. So it really comes down to Nick and I and our ability to invest the money in a concentrated way in our best ideas, and to get the stock selection right through our 7-factor framework.
Well, I was going to ask about that. You've nicely led into that, Jarrad. So high conviction, small number of stocks. You have to be right on point about the ones that you really want in your portfolio. So how do you go about the process of making sure that those 20 are really the ones that you think are going to outperform?
Sure. So we start with all the global stocks listed, more than 10,000.
It's a lot to start from.
Absolutely. And we have a very automated process to run through several filters. There's 7 factors we run through, such as valuation, insider activity, catalyst for the stock. So 7 factors that we look through for all the various companies, and then that gets us to a research long list, followed by a short list once we go through a scoring process and cut out the vast majority of companies that don't meet the filters. And then from there, it becomes a lot more manual, and we tediously go through all the fundamental characteristics manually, and pull through the financials and come up with a short list of 50 names that we're happy to buy. And then it really comes down to timing, and when we see the best opportunities in the market to actually buy those companies.
Along with our own unique scoring system as well to weight those stocks within our portfolio as well.
So are there particular factors that you're much more keen on, if I can put it that way, and that matter more versus others?
It's really a range of things. And yes, some factors have different weightings. So across valuation, we look at DCF, PE multiples, but even EV to EBITDA multiples as well. So it really comes down to within each of those criteria, how we weight everything and rank everything. And I guess that's a bit of the secret sauce as to how we prioritize what's important. And then later on, even things subjectively like the themes that are playing out in the marketplace, exposure to things like AI and defense that have been good performers. So there's a range of factors that go into it, into the melting pot, I guess.
So over the last 12 months, markets have been up and down. So it's been an interesting time. We've had geopolitical conflict. Mr. Trump likes to tweet things or X things. I don't know which way is the right way to put that now. So in that time frame, and since the launch of the fund, there must be some ups and downs in the market. What have you learnt from those ups and downs? Like, what have you taken away from those things?
Yeah, there's been three kind of key events that I see that have played out in the market. First one was that sell-off around Liberation Day, the Trump tariff sell-off. And I guess we started towards the bottom of that. So I guess it was hard to think that that might be a good buying opportunity long term. But the key for us was really staying true to label, fully invested on day one per our mandate. So that was the key there. And we benefited from that recovery as well as the good stock selection.
So what was the learning that you took out from that?
Really just to be true to label, follow the mandate. That's what we've promised investors. So that's the product we need to deliver, whether it feels right or otherwise. The key is just to stay true to our process and true to what we've committed to.
But it must have felt uncomfortable at times.
Yeah.
As the market bounces around.
Absolutely, yeah. Markets were selling off quite aggressively at that time, and you think, is that the time to start a fund? And in hindsight, it was fine. But in the moment, when all the news is happening and everything's red, and you're running a relative fund, a relative performance style fund, it can feel quite uncomfortable.
And was there any particular moment where it was super uncomfortable, and what was driving that?
I'd never say uncomfortable. It's always unsettling to a degree, but you trust your process. On the long-term average, markets go up. And it's all about trusting valuation, trusting process.
We really try to tilt the portfolio when things are out of favor, and we look for contrarian plays that could be beneficial in terms of making money for the funds. So another one was that tech sell-off around January, February. And so we used that sell-off to just top up on our tech and AI exposure, because we saw that as a structural growth trend, and a short-term blip being an opportunity to buy more. Then the third event, I guess, was the US-Iran war, and that was quite a significant effect on markets. We also had a small drawdown of around 5%, and so that was actually our only negative month in the whole period of 14 months. And I guess what we learnt from that was just again, stay true to label, follow our process, and let the process deliver the results.
You've got a high conviction approach, right? Which is great. So I assume you have a view on ETFs and passive investing, because a lot of the weight of sort of general money is actually hitting that part of the market, and it's creating some distortions and some things that people weren't sort of probably cognizant of before. So I've got a sort of a two-part question for you. Your view on passive, and then in particular, where do you think active can make a real sort of difference?
Yeah, it might come as a little strange. We actually believe passive is a very good strategy for a lot of investors. It actually fills a core portfolio of most people's portfolios these days. And the studies show it's very hard to outperform as an active manager. So passive ETFs are a great way to just get exposure to a market when you don't have a view of which stocks or which areas of the market might be the best to be invested in. And so normally you'd have an active manager approach being a satellite, so a smaller percentage of people's portfolio, particularly a high conviction fund like ourselves, and that fits in like a barbell approach or a core satellite approach. with the passive doing most of the hard work, and then the outperformance coming from the boutique managers that can generate outperformance through disciplined stock selection, looking for those undervalued growth companies that are well positioned.
And why do you think it is that it seems to be that it's boutiques in particular that seem to be able to leverage this sort of active outperformance piece better than sort of larger institutions?
I guess it just comes down to the weight of money, really. Too much money to manage makes it very hard to get the great returns. So small, nimble funds have the ability to move in and out of stocks and get the outperformance. Bigger managers or more established managers have a lot of clients and a lot of money, and they might have a great strategy, but to actually get the liquidity in the stocks that they need to execute that means that the outperformance can be low or very small that clients are actually receiving in compared to a boutique manager that has some runway before they hit liquidity problems.
Now, I want to just touch on something that's a little bit sort of more contemporary. So we've just been through the federal budget. There's been a lot of changes and a lot of conversation about the budget. In your opinion, what's going to be or what may be the impact on, and again, another two-part question, investors? Do you think it's going to change how investors approach the market and how they invest? And then will it have any impact on markets itself? What's your view?
I think we've already seen impact on markets coming through. Post-federal budget, you can see the real dislocation of, say, the S&P 500 and the ASX 200, or the Australian property market compared to overseas markets. So we've really seen the Australian markets have an impact from the budget. Obviously, higher taxes are not good for after-tax returns for clients and investors. So that's really had a significant impact, and we'll see that play out, I think, continuously down the line as the changes come through. In terms of us and where we fit, global companies, obviously Australian investors still have to pay Australian tax. The companies themselves, though, that are in the S&P 500 or offshore listed companies or unlisted companies for that matter, those companies don't have operations in Australia, so those companies are largely unaffected by the recent changes to the budget, and that ultimately means that the pre-tax returns are the same for those companies, but then it's just the Australian tax, the end tax that the investors have to pay. So the pre-tax returns that we produce can still be relatively similar despite the budget changes.
Do you think there's going to be a swing into more income-focused opportunities versus sort of those that may be more focused on capital gains over time?
Definitely see that playing out because obviously the CGT changes are reducing the discount on capital gains. So the bigger companies that are focusing on yield and paying out dividends consistently actually get a benefit, whereas the smaller companies that are more nimble in reinvesting in high rates of growth in their businesses are actually struggling more so in that environment to produce results.
Well, I guess frank dividends are going to become even more popular, which is going to drive an interesting sort of impact, right? If companies then focus on paying more and more money out rather than reinvesting it into their own growth plans, which seems to be what happens in the States much more than Australia.
Definitely, yeah, absolutely.
Now, just sort of on that Australia global divide, it seems to be that, you know, the old days were 50 or 60% of your portfolio may be allocated to Australia, and then only 10 or 15% allocated to overseas exposure. That seems to be very much reversing now. Just sort of obviously got a global fund. Is that something that you're seeing in conversation with investors?
Yeah, we're seeing that on the ground where clients are taking their Australian profits or income they're receiving or cash that they've got in Australian dollars, and they're actually looking to invest that, and when they're making that decision, they're going to often a global managers such as ourselves, and we're definitely having those conversations with people on our roadshow that came up consistently. And also seen that across the marketplace. If you look at other large funds, multi-asset class funds, super funds, they're on a relative basis shifting from Australian equities across to international equities as a whole. Not every fund, obviously, but in general, it's a strong trend that's been happening the last couple of months.
And the big industry super funds have already done that, right? They've already moved a lot of their sort of investment firepower overseas. So maybe we're not seeing the death of home country bias, but certainly
the beginnings of it.
Yeah, it's probably people will be more aware that Australia seems to be a bank and resources market, and that's not where the high growth actually is.
Correct, and obviously property has had the impact from CGT, particularly residential, and that's sort of flown through now as well to the banking sector. So the weaker property market's flown through to the banking sector, and as we know, banks make up a large part of particularly the ASX 200, the Big Four and Macquarie. So those companies are probably struggling a bit on that basis, although they do produce, as you say, the yield income perspective, but they've sort of been hit from around the corner by the impact of the property market just slowing down and tempering their growth plans.
Yep. And one of the themes that is sort of, I guess, the theme of the day is AI, right? We have the SpaceX IPO. AI is everywhere. It's all everybody wants to talk about. From your perspective, is that a theme you're keen on? And then what do you see where do you see is the upside in AI? And there's many different layers of AI, I appreciate. And then where maybe you see some challenges, if we can kind of split it into the positive and the negative at the same time.
Yeah, looking from a broad perspective, our portfolio, we're roughly 22% technology. The MSCI World benchmark is actually 30%. So we're actually underweight tech, which might surprise a few people. We're big believers in the theme. However, we're really selective in trying to pick the eyes out of it and focus on those companies that can deliver. And I guess just being cautious because it is such a large weighting in the index. So in terms of our positioning, we really like things like data centers, power, demand.
The ones who make the money are always the ones selling the shovels.
Yeah. Memory stocks are another one that's worked really well for us. So we have made some really good returns from that sector, but we're very cognizant of risk and staying diversified across multiple sectors and multiple countries.
We've seen some of those companies go stratospheric in terms of the returns, and SpaceX is just one little sort of example of that.
We don't get lost in the hype. We're happy to trawl through the data and find stuff with true values. So yeah, look, they are there. You've just got to look for them.
Because there's a lot of change happening in the sector, you do get that dispersion of valuations. So you can get companies that are trading on 100 times plus PE multiple, but you can also get some things as well that are below market, below 20 times PE multiple.
Because 100's hard to justify, right?
Very hard. Can be, yeah. Obviously, always looking relative to the growth of the business, as versus a traditional industry where the valuation's a lot more compressed. Yeah. AI and technology provides that opportunity for us to provide that valuation discipline and look for those outliers, as Nick said, to find good value in that sector.
Yep. So I'm just, this is going to be an aside question. We can cut it out if we don't want to, but is AI a boom or a bust?
I think it's a long-term growth structural trend in the marketplace, and it can continue to run for several years, although we are going to see some pullbacks and setbacks along the way as various things get digested. It's not going to be a one-way street, but overall we are believers that the sector will make great changes to the world and will play over the next several years.
Well, sometimes it's overestimated in the short term, underestimated in the long term. Yep.
Absolutely, yeah. And there's a lot of hype in a few names. We tend to stay away from those recent IPOs, such as SpaceX, that are trading on quite high valuations. Look for those companies that are supplying to the industry, that are trading on more reasonable valuations compared to their growth prospects.
So one of the other thematics that you very briefly mentioned at the start, so maybe if you could each individually give me your favorite outside of AI. So if you were to pick a thematic that you think has got lots of value or lots of unheralded value that has got some time to run, what would it be?
I would say the aging population globally across the developed world. So there's going to be just continued growth in that space over time. It's not particularly sexy, but the valuations across that space are pretty modest. So we really like that space when we can find a good company performing well.
Mm-hmm. And Nick,
Defense. We've obviously had Trump come in, go,
well, all the missiles have been shot, apparently.
I don't think he's done yet, but anyway, time will tell. We've obviously had the exit of NATO, or seeing the exit of NATO as a potential. So defense spending, everyone's going to have to stand on their own 2 feet. It's just boring companies, really.
So when you think about then a portfolio that you've looked at the thematics, you've run through your process, when you're looking at your existing portfolio right now, if you were to play sort of the black hat type game, where would you see, where are you worried? Maybe worry is the wrong word. But what are you very conscious of that you've invested in that you're keeping a close eye on?
Definitely that AI technology space. As I said, we are underweight. It can be a volatile sector, and because it is such a large part of the index, not that we particularly focus what's in the index, we're really focused on stuff that's under researched and not covered and smaller often. But that sector to me seems quite hot here, even though the trends and the themes look great and there's a lot of money going to that space. It's going to make a huge difference to the world. Just in the short term, it seems quite hot, and there's a lot of money, particularly, as I said, with the IPOs coming through from Anthropic, SpaceX, and a number of others.
So are they going to suck up more capital than the market has? Are they all going to get funded? What's your view and what's going to happen there?
Hard to tell exactly what's going to happen, but it does seem like a number of those IPOs will get away. And usually when you've got that froth in a marketplace, that is a signal that things can be a bit expensive. And so just in the short term, it's something we're very wary that space might be running a bit ahead of where the actual economics or fundamentals are in that space in the shorter term. And hence why one reason we're underweight.
Yeah, and if there's some private equity firms pumping some IPOs out, it's you always got to know where the money's been made.
Exactly.
So if we look at sort of global equities on a sort of, when you painted the picture of the universe, there's a lot of stocks to look at. A lot of countries, a lot of stocks, a lot of themes running. Markets have been on a bit of a tear. So they've been going up. They've bounced around a little bit, but generally they've been on the way up. What's your view on the next sort of medium term? So if we were to look out 3 to 5 years out, how comfortable are you that growth that you've already seen is going to continue?
There's several factors here at play. Overall, quite bullish over the next 3 to 5 years. As I said, this sort of winter months for us or summer months for the US can be quite challenging from a seasonal point of view for the market. Valuations are quite stretched. But on the other hand, US corporate earnings in particular have been getting revised upwards. And so that's actually showing that the fundamentals for the economy are very strong and that company fundamentals are going very, very well.
So is US exceptionalism still alive?
Whether you love him or hate him, Trump is making a huge difference to the stock market, and we see that sort of playing out over the rest of his term. but a lot of it is sort of factored in as well to the market prices. So there's many ways the market could go. We're sort of somewhere in the middle would be our view, because valuations are also quite stretched. But over 3 to 5 years, usually taking that longer term horizon, we do see markets tend to grind higher over time.
And obviously, the US is the biggest and most liquid market. We said, US exceptionalism is probably the capitalism is the hardest still beating, and beating quite strongly. But outside of the US, are there any sort of other undiscovered pockets, maybe geographically or in areas that people aren't quite sort of aware of, that you've stumbled across that you think add value?
Yeah, I think Asia for the long term does provide a lot of value in terms of the multiples are quite low. So always looking for good companies in that space that we can understand. We generally stay with the more developed markets, but that'd probably be one area I'd highlight as longer term, something that could produce some quite good returns.
And what in particular in Asia is driving that opportunity?
I think it's just population growth, fundamentals from their economy, the underlying strength of the shift from sort of west to east. So economies like Japan, India, China really going very strongly with emerging markets at the moment.
Well, I think India is now the most populous country in the world, right? So it's a market that's only going to go in one direction.
Stock market there has rallied very hard in the last few years. Yeah.
Yep. And didn't have any space companies on it.
No, exactly. They do have a quite a large and prosperous tech sector, but no space companies though.
So maybe just sort of to wrap up the conversation, if you were to look back sort of since the formation of the fund, so you got sort of some experience now built up in sort of being in day to day and running it. What's your key learning to take out from sort of day one to now?
I'd say don't get too drawn up in the emotion of the day-to-day movements in the market. We tend to hold companies on average for 2 years from the day we buy them on average. So we're really looking to do our due diligence on a company and understand the businesses really, really well before we take a position, and then just continue to hold that for long term. That's the key for us, and staying true to label, being fully invested, staying diversified across both country and sector, and just delivering our investors a solid return over that longer term horizon.
And number one learning for you, Nick?
Completely agree. That is words out of my mouth, Jarrad.
Well, it's good to see you both 100% on the same hymn sheet, which augurs well for the future. Jarrad and Nick, thank you for your insights today. If you like what you saw or what you heard, please subscribe, share, or leave a comment on the channel of your choice. This really matters in helping older audience members find us. And for more insights like this, and to search, find, and compare hundreds of investment products, including the Sharpbridge Funds Management Global Equities Fund, please go to investmentmarkets.com.au.